Good afternoon, everyone. It's good to see you again. I'm going to be covering three broad topics today. The first is going to be catastrophe modeling, as you've heard, but we're also going to talk briefly about capital convergence as well as innovation. Against this backdrop of uncertainty that we have heard from my colleagues today, GC Analytics has spent a tremendous amount of time and energy over the past year in collaboration with our brokers in helping our clients to identify, understand, and manage their risk exposures. Our job was made more challenging by many of the perils and events that took place that Chris has already articulated. But we're also dealing with a very disruptive force this year, a slightly different event. In fact, it's a man-made event. And what I'm speaking of is the major disruption to the insurance industry caused by catastrophe model changes. In a short period of time, insurers have been faced with a handful of model changes, most notably by RMS to the RMS model version 11 of the North Atlantic hurricane model, and changes by AIR to the version 12 of the European wind model last year. Now, CAT model changes by themselves are not the most disruptive event to hit the market in the past 12 months. However, we do think that recent model changes will be disruptive through the 2012 renewal process. To be clear, we believe these models are very useful in assessing risk exposures. It's no surprise that they have become essential tools for any insurer underwriting catastrophe loss coverage. However, these models reflect a highly imperfect science, and they carry levels of uncertainty far greater than their influence would suggest. In a way, CAT model influence is a bit like the tail wagging the dog. We, the industry, need to put these models back where they belong, as one of a number of risk management tools, providing insurers with a better understanding of their risk on a relative, not an absolute, basis. On the whole, recent model changes have been improvements, not necessarily because the science is better, but because the model math supposedly has caught up with some of the reality of the underlying and existing risk. However, all models, whether those be catastrophe models, economic capital models, or financial earnings models, have a material degree of uncertainty inherent in them. And for a number of reasons, it's often not fully understood by the model users. The new CAT models released recently by vendors are no exception. So how can we validate whether or not all these model changes are actually improvements? At Guy Carpenter, we look to measure, test, and assess models along a number of different factors. Two of those factors include model transparency and model uncertainty. Model vendors cannot expect to be partners within the insurance industry if they are regularly producing and introducing opaque tools. On behalf of our insurance clients, Guy Carpenter is calling for greater model transparency to help insurers better understand their actual risk and relative to the model's underlying assumptions. For example, the slide that we're showing here is looking at what we would call for in terms of transparency around U.S. hurricane models. We need greater transparency around the frequency of events by geography. We need greater transparency with regard to industry losses relative to historical events. And we need much greater transparency in terms of vulnerability and the assumptions going into those models. Let's turn our attention now to the issue of model uncertainty. This is a very telling slide. What we did is we took an insured portfolio and plotted an exceedance probability curve using all three major models. The results are those solid lines that you see grouped in the middle. And as you can see, they all more or less tell the same story. The dotted lines are the self-reported uncertainty bands. These bands are decided and reported by the vendors themselves. And there are a couple of points that we would like to make here. One is to see how wide the bands are over almost any period of time. If you look at the return periods, the lower band and upper bands tend to be extraordinarily high. Two, note how different the various bands are from one another. All of these models work off essentially the same historical data, but for a variety of reasons, they report very different degrees of uncertainty in the results. So let me help you in terms of how to interpret this slide. What the slide tells you, if you're a cat modeler, is your 100-year period loss is around $61,877,677,213 US dollars. What the slide actually means, however, is that your 100-year return period loss is about $60 billion, but it could be as high as $120 billion, and it could be as little as $15 billion, something in between. When model changes take place, there tends to be a lot of press around the model's, quote, enhancements, but very little is said about this issue of model uncertainty. We think the lack of attention of model uncertainty, a lack of attention from the vendors, by the rating agencies, and indeed even the press, is leading the industry into a false sense of the model accuracy. If users understand the truly high degree of uncertainty that exists in these models and their loss estimates, then they will be more thoughtful in making exposure management adjustment and changes after new models are released. The decision of which catastrophe model to use contributes to a company's overall operational risk. And so with that in mind, Guy Carpenter has begun to encourage our clients to take a multi-model approach when assessing total portfolio risk. And there are a number of benefits to a multi-model approach. First, you get the diversification away from single model risk. Second, users will be able to select the right tool for the right job. Third, we think using multiple models gives the opportunity to expand your data set. And fourth, we believe that a hybrid approach, a blended approach, will allow insurers to reduce the volatility that's created whenever model changes take place. So again, we ask the question, how can we determine if these models are improving? To answer this, Guy Carpenter has undertaken major research initiatives to better understand catastrophe models, what they do right, and where they come up short, so that we can in turn help our clients to understand how to best use them. We've begun putting some of this thinking to work with our clients, and of course we'll be publishing a white paper of our model analysis and recommendations in relatively short order. So let me turn now to capital convergence. This is the secular trend that we see in the industry, the convergence of traditional and non-traditional capacity sources. As funding requirements become increasingly important, our clients are increasingly viewing all sources of capacity, whether it be contingent, replacement, capital, or traditional reinsurance. Guy Carpenter estimates that the non-traditional capacity source account for about $30 billion US dollars, which is approximately 12% of the total property catastrophe capacity. And we project that non-traditional sources will grow at a compounded rate of about 7 to 8% over the next 3 years. While events over the course of the year have tested the market's resolve, institutional investor appetite for reinsurance risk continues to be on the rise. This was proven by the point that we saw over $1 billion of contingent sidecar capacity raised in the course of several weeks following the Tohoku earthquake. That interest by investors is not surprising in the current environment, considering the yield pickup and the non-correlated nature of these types of investments. Turning quickly to M&A activity, deal flow year to date is about the same as what we've seen in the last 2 years, in 2009 and 2010. Our belief is that growth through acquisition is going to be very difficult in an environment in which stock and credit markets remain in turmoil. And we think that the pace of deals for the remainder of 2011 will remain low. Without easy credit, however, we think that the conditions are in place for mergers and acquisitions to reassert their fundamental purpose in the capital markets. And that's for strong corporate performers to match acquisitions with their long-term strategic objectives and to drive out weak, inefficient players. As you've heard repeatedly from my colleagues today, we believe there are areas of opportunity in this period of uncertainty, and we think this theme applies for M&A. Finally, a quick word about innovation. For nearly a century, Guy Carpenter has been serving its clients by delivering innovation, cutting-edge analytics, and advice. I want to briefly touch on a few of the things that you'll be hearing about over the coming months. First, we've been very successful in the introduction of our Quill product this year. This is our county-weighted index loss coverage. Quill helps our insurance clients refine their calibration of risk exposure and match the coverage to much more specificity to their actual underlying risk. In many examples, we saw Guy Carpenter's clients were able to achieve about a 20% cost benefit through Quill when compared to traditional reinsurance products. Since Quill's introduction, Guy Carpenter has placed over $3 billion of limit, and Quill was recognized by the industry for its innovation and its impact on the market when it was awarded the 2011 Trading Risk Derivative of the Year. Also, we have recently launched our Solvency II advisory services, very much consistent with what Nick and Chris have talked about. We've been a leading global authority on Solvency II ever since the initiative is underway. And in fact, our new reference paper, Succeeding Under Solvency II, is available for you today at the back of the room. From analyzing and modeling capital requirements to implementation of enterprise risk management to sourcing capital and reinsurance solutions for our clients, Guy Carpenter brokers are able to bring a fully integrated solution to help our clients meet their individual needs. Lastly, Guy Carpenter has moved into the area of predictive modeling and predictive analytics, and announcing a new strategic relationship with Eagle Eye Analytics, the global leader in predictive analytics solutions for the insurance industry. Eagle Eye's proprietary data analytics and modeling process enables carriers to segment, select, and price insurance risk more effectively. At Guy Carpenter, this capability is allowing us to deliver assistance and advice on a much higher proportion of our clients' risk exposure, more so than ever before. So in conclusion, at Guy Carpenter, we believe that our proprietary and collaborative approach to innovation, research, and development is indeed helping our clients to better identify, understand, and manage their risk. And this serves as a core pillar to our strategy as a firm to be our clients' most trusted strategic advisor.